This is one of those questions I frequently encounter. While the answer is not simple, it's not too complicated either, given the fact that technology has handed you tools you need to select the right company right at your fingertips. But it can be tedious sometimes. I will answer this question by first explaining the age-old and most successful approach to investing, which is using either a top-down or a bottom-up approach. With the top-down approach, an investor will first need to analyze the economy, then the sector, and then narrow it down to a company within that sector. With the bottom-up approach, you reverse the same process. Analyze a company first, then its sector, and finally the economy. To analyze a stock or a company, you need to look at various qualitative factors such as business model, economic moats, growth drivers for the company, and risks and concerns faced by the company. You also need to look at the financial health of the company by analyzing its profit and loss statement, balance sheet, cash flows with the help of various valuations and financial ratios. In the end, you need to value the stock with the help of ratios such as price to earnings ratio, price to book ratio, or an EV by EBITDA ratio. And you can use also many advanced techniques. A sector analysis involves an analysis of several factors such as demand and supply of the product in the sector, competitive forces impacting the sector, growth drivers that drive the demand for the products, and any possible government regulations that impact the operations of the companies in the sector. Lastly, you also need to look at the macro picture by looking at any mega trend which is playing out in that sector. For example, a production-linked incentive scheme which would benefit the Make in India initiative, or a technological revolution towards artificial intelligence and cloud computing. Such mega trends help you invest in winning companies falling within these sectors. Macroeconomic indicators such as inflation and interest rates have a substantial impact on the demand for the products as well as the cost of producing these products. Ultimately, it also impacts the company earnings. While it may get tedious, it is a time-tested method endorsed by the best in the business. If you like shortcuts, you can use ready-made or customized screeners now available widely online. An investor can use several parameters such as debt to equity ratio, revenue and profit growth, return ratios to select fundamentally sound companies. Thank you. This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing.